Wow. Well, hopefully we've provided you with a little bit of food for thought today. I know I've learned a lot, and I thought your questions were really fantastic. I know everyone's sort of struggling with this idea of what's next and how do we engage. Are we ready to engage, or do we have some more time? So hopefully you've at least thought a little bit more about that, and as we're thinking about how we're approaching things in the future as regulators and supervisors, we'll have an opportunity to talk with you more about what you're thinking you want to do in the future and how we can empower you to do that, or we can help you understand how to be safe and sound in engaging some of those activities. But as we wrap up today's conference, I want to thank all of our moderators and our presenters on today's panels. And of course, I want to thank our Treasury Secretary, Scott Bessent, for sharing his perspectives on our nation's community banks. So many of you have told me throughout the day how invigorating it has been and how it's really increasing your enthusiasm and sort of changing your outlook to see such engagement on these issues across the government. So it's exciting to be a part of this sort of change and approach. And all of the community bankers and state regulators around the country who have attended today's event, I see Arkansas and Mississippi are with us here in the room, but those of you joining us virtually, we're grateful to have you as well. I want to recognize our staff here at the Federal Reserve whose hard work have made today's conference possible. So if you don't mind, I'm just going to give a shout out to each one of them. But generally, I want to thank our community bank portfolio that's led by Karen Kaplan. But her team, Amanda Roberts, who's fantastic, who is our MC today. I mentioned Karen, Josh Smolovitz, Andrea Knorr, Greg Jackson, Dedrick Jeffries, Joe Timpone, Trevor Gaskins, Olawale Makunda, Hetvi Patel, Virginia Gibbs, Brianna Curran, and Amal Vida. Thank you so much to all of you. And of course, I want to thank Alexandra Wells, who really helped us put this event together today. And I'm sure all of you have had a chance to meet her or communicate with her as you've been attending the conference and participating. So thanks to all of you. But I just want to share some thoughts because I don't often get, because of my new role, I don't often get to talk about the things that we're doing on the community bank level here from the supervisory and regulatory perspective. So I just want to go over a couple of things with you that you might find interesting. Of course, we know that community banks drive local and regional economic growth. And you all play a central role in the financial health of the customers and the communities that you serve. Your banks often pursue unique business models, some more unique than others. Eric, I think, is a good example of that, our last moderator. But your models are ones that are not easily replaced by larger banks, especially through that relationship banking model, which is a central tenet of community banking. But in today's environment, many community banks are embracing innovation, and they're continuing to evolve to better serve their customers in the current and the future financial system, which was what today was really about, the future financial system. Our focus today has been on community banks, how you continue to innovate, how you continue to rise to the challenge to support your customers as the financial landscape continues to evolve. Our legislators and regulators, and we had a legislator in the room today, a member of Congress was with us, and he asked a great question about KYC and BSA and how they're thinking about that going forward and fraud. So they're also thinking deeply about how we can all rise to the challenge to ensure that the community banking system continues to thrive through the critical task of ensuring that supervision and regulation are appropriately tailored. Our support for community banks cannot just be lip service. It must translate into specific actions that right-size regulation and apply appropriate supervisory standards, specifically in identifying the appropriate definition of a community bank, in establishing appropriately tailored regulatory thresholds, and in approaching supervision that's focused on material financial risk. So what is a community bank for this purpose? Generally, the regulatory framework uses the blunt tool of fixed asset thresholds. We know that relying solely on fixed asset thresholds is imperfect at best. They fail to account for economic growth and inflation over time, resulting in stable firms with stable growth, consistent business models, and no change in their risk profile crossing asset thresholds and becoming subject to increasingly complex and burdensome regulatory requirements and supervisory expectations. This is clearly not the intended or the desired outcome, in that crossing these fixed thresholds has the unintended consequence of pushing down standards that are designed for larger and more complex banks to the smaller and less complex ones. Compounding this problem is the overlapping and inconsistent thresholds that are used to define banks of different sizes and engaged in different activities. We should question whether this additional complexity is necessary or helpful, and whether it's detrimental to economic growth. A simple fix would be for policymakers to adjust the community bank and other thresholds based on growth, as one of you mentioned today on your liquidity and capital panel. And we could apply that adjusted threshold consistently, indexed against, to adjust for future growth. This approach would preserve the policy choice established when the threshold was initially set. Defining a community bank is an important first step, but it's really just that, a first step. The next question is how to appropriately tailor our regulations for those firms. Over the years, I've supported an approach to regulation grounded in asking some simple but critical threshold questions. What problem does each new and existing regulation solve? What are the costs of that approach? And importantly, what alternative approaches are available? When we look back at existing regulations, we can clearly identify areas that could be improved. For example, we've also talked today about the community bank leverage ratio as an optional alternative framework to risk-based capital requirements for community banks. A community bank that opts into the CBLR framework and complies with the established ratio is deemed to comply with risk-based capital requirements. But if we look back at the history of the CBLR, the agencies approached the task of calibration primarily by evaluating how many banks would be eligible to opt in, and calibrating the requirement to maintain the same high level of capital in this population of banks. In my view, this approach failed to achieve the relief that Congress intended. And more fundamentally, it failed to answer the critical questions we must consider in the rulemaking process. Let me turn to another prominent area that needs to be addressed. Even the regulatory applications process can have a negative impact on community banks. This process requires banks to seek approval from the Federal Reserve and other state and federal regulators for regulatory permission to engage in a transaction or an activity. The process can be unpredictable in terms of timing and information necessary to be ripe for consideration and approval. The costs of delay can be significant, as I don't need to remind all of you, which can damage the value of the target bank, creating uncertainty for bank staff and for their customers, and resulting in costly delays for critical systems integration contracts and service agreements, potentially damaging the reputation of both firms. The remedy is simple. Regulatory application review should be effective, timely, and efficient. Banks should have a clear understanding of the information they must provide to complete that application well in advance. The standards for approval must be clearly defined and available to the public. And regulators should be prepared to act to complete the application within the statutory timeframes. We've had an opportunity to take a new approach, or we have now an opportunity to take a new approach, and we are doing so. We cannot accept the opacity of the status quo, especially when the fix is as simple as clear standards, clear forms, and the prompt attention to and action on applications. One area where we have improved transparency relates to mutual bank capital. And I did notice that several of you are mutual banks that served on our panels today, so thank you for participating. And I've spoken about mutual bank capital a number of times. Yesterday, the board issued a series of frequently asked questions and 2 templates for mutual banks to use as they consider engaging in raising capital. These provide options for mutual banks to issue capital instruments that could qualify as Tier 1 common equity or as additional Tier 1 equity. These approaches are just a start. We've had a number of conversations about several different approaches, and we want to make sure that once you've had a chance to review these processes, that we are open to further refinement and improvement once you have an opportunity to think about how effective these are with implementing the desired outcome. So I want to conclude with the discussion about how we ensure that the supervisory process is appropriate for community banks. Regulators are once again working to incorporate tailoring to more effectively allocate supervisory and bank staffing resources. This allows the calibration of supervisory activities that are appropriate to a bank's size, risk, complexity, and business model. The approach is not new. We've talked a lot about it today, but it's simply been ignored in recent years. Regulators have significant leeway in designing supervisory approaches, which may include issuing guidance that is technically non-binding, but often plays a role similar to a regulatory requirement. So how do we address this problem? First, through greater transparency. Supervisory practices often escape public and internal scrutiny. They're developed with little public input, and they're not subject to public notice and comment requirements under the Administrative Procedures Act. Supervisory practices are not scrutinized after an exam because of the activity's designation as confidential supervisory information. CSI includes a broad array of bank and supervisory materials and actions that are taken within the exam context. The Fed continues to revise and redirect our supervisory practices, including the shift in focus toward material financial risk. And these efforts would be most effective if accompanied by revisions to the definition and scope of CSI, which would promote greater public transparency and accountability. Second is the calibration of our supervisory standards. Supervisory findings inform our bank ratings, which can have follow-on effects like limiting options for mergers and acquisitions activity, raising the cost of liquidity, or diverting resources away from other more important bank management priorities. We need to ensure that supervisory practices are appropriately calibrated so that a bank's supervisory ratings reflect its financial condition and material financial risks. But before we close out today's conference, I'd like to, again, thank all of you for being with us today, both those of you who are here in person in Washington and those of you who've joined us online. We appreciate your continued support for community banks across the United States. And I would especially like to thank the community bankers who work tirelessly to support your customers, your local businesses, and your local economies. Thank you for joining us today and taking time out of your schedules to be here in person. In my role as Vice Chair for Supervision, my responsibilities extend across banks of all sizes, from the largest GSIBs to a single branch community bank operating in an underserved rural market. The Fed's regulatory and supervisory approaches to this wide range of firms must be tailored to address the unique characteristics of each type and size of institution. A one-size-fits-all approach that pushes down requirements from the larger banks to the smallest ones results in over-regulation and excessive supervision that is not appropriate for the bank's size, risk, complexity, and business model, especially for community banks. Today, we have the opportunity to right-size the frameworks of each size of institutions, and I look forward to working together with my colleagues at the FDIC and the OCC to accomplish this goal through sensible reforms and more appropriate supervisory approaches. So thanks again for joining us today, and I look forward to keeping in touch.